Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. After the bell, Nvidia forecast revenue for the current quarter below the most lofty expectations. Fiscal fourth quarter sales will be about $37.5 billion. Here's the thing. The range of analyst estimates was as high as $41 billion. Let's take a closer look now at the Nvidia story with Angelo Zino. He is Vice President of Equity Research at CFRA. Angelo, what did you make of what you heard today from Nvidia?
Yeah, so thanks for having me. I think overall the results were pretty good, and nothing that I'm concerned about here. To your point, they provide guidance that I think was, it's about $1.5 billion or so below maybe where the whisper numbers were looking for, but definitely above our expectations. We were actually looking for about 37 billion in the January quarter. And I think, all else equal, when you kind of look at the beat that they had in the October quarter, which was about 2 billion out there, definitely shows that their demand remains very strong for their offerings. I mean, in the October quarter, it was largely driven by their Hopper architecture. As we kind of look ahead here in the January quarter, it was all about the cadence and trajectory of the Blackwell ramp here. And at least, from the initial kind of view here, it seems like Nvidia is being somewhat conservative in terms of that initial ramp, with kind of a stronger ramp kind of going into the April and July quarters.
Are you concerned at all that maybe just a bit the excitement that we have seen over artificial intelligence may be getting a little ahead of reality?
Well, I guess what I would say is, at some point in time, investors, almost kind of become numb to this stuff. And, from that perspective, we could potentially be, entering a point in time here where investors might kind of be willing to look elsewhere, at least over kind of the next 6 to 9 month period, especially with kind of a new Trump administration entering, and that kind of, typically kind of helping more maybe some of the higher beta, more cyclical type names that maybe have underperformed. So maybe from a sentiment perspective, we can kind of see a period where some of these AI-oriented names take a step back. But that said, when we start looking at the fundamentals, the major drivers for these AI semi stocks, as well as Mag 7 names here over the next 3 to 5 years, we still remain extremely optimistic about the fundamentals of these companies and believe that they will continue to be primary drivers of growth for the broader markets here in the coming years.
So as we both know, Nvidia is restrained by the policies of the Biden administration from allowing China to have some of these most advanced and sophisticated graphics processors. You mentioned the Trump administration and perhaps a little bit of change in economic policy. Do you think the Trump administration will continue the Biden administration's hard line on chips where China is concerned?
Well, I think that's a great question. I think we have to wait and see. But I will say this, we do think kind of Nvidia may be more of a beneficiary under kind of what we would call a transactional based approach under a Trump administration. So when you kind of think about the Biden-Harris approach, it really has been a kind of limit China to certain advanced chips and equipment like GPUs. EUVs is another great example made by the likes of ASML. But according to our Washington analysis team, Trump, we think, might be willing to offer more advanced AI chips to other nations, even China, if the price is right, while kind of maintaining a certain technology lead. So, China is held maybe a generation or two behind. So this could drive, we think, higher related NVIDIA revenue in regions like China, where the company could potentially be able to sell, let's say it's A100 versus maybe more of a performance laden H20. So we see the potential for NVIDIA to potentially actually be better positioned under a Trump administration relative to a Biden-Harris administration.
I think we can agree that the centerpiece of the Trump policy with respect to China on the economic side, tariffs. What do you think the fallout will be as the result of tariffs that may approach at least 60% and maybe even more than that?
Yeah, I mean, listen, on the surface, if they were to go through the way they are intended to go through, if we're looking at 60% tariffs in China or in north of 20%, let's say in Mexico, for instance, clearly it would have a negative impact, I'd say, on the broader tech sector. And a big reason for that, if you think about a third of all electronic goods within the tech industry is actually manufactured out in China. And when you think about how important Mexico is for industries like the automotive space, a number of industrial markets out there where a lot of semiconductor goods are kind of imported from there, not to mention, the number of PC vendors like the Dells of the world. So there, definitely kind of implications. It'll have a negative impact and inflationary pressures, I'd say, to the overall tech space as well as broader markets. So it's not necessarily something we want to see. But in the same respect, we think the Trump administration will kind of be a little bit more tactical out there. So all in all, it's probably going to be messy here for a little while. And I think investors just have to be kind of willing to kind of go for the roller coaster ride.
Angelo, I'm not hearing a lot of concern from your perspective about further decoupling of the trade relationship between the U.S. and China. Is that the case?
Again, I mean, listen, I think it's something that we have to, just kind of wait and see how this all plays out. I think kind of initially the way we would kind of look at it is I don't know if there would necessarily be kind of more of a decoupling to kind of be seen. But again, it's something that we kind of have to wait and see.
A lot of what we've been focused on are the nominees for various cabinet positions. We still don't have a nominee for Treasury Secretary. We do know that Howard Lutnick will be at Commerce, and a part of his portfolio will include the Office of U.S. Trade Rep. Generally speaking, when you assess the appointments that have been named so far, what is the takeaway from your point of view on how the Trump administration will proceed with governing?
No, I mean, that's a good question. I mean, when we kind of think about, at least initially, what what the impact is going to be to the broader tech space, I'd say right now it's one where hopefully we kind of see the ability for greater M&A potential within the tech space, and I would say that would kind of cause us to lean a little bit more in favor of the software space relative to the semiconductor industry. I think there are a lot more uncertainties as far as the semiconductor industry is concerned, whether it's to your point about tariffs, whether it be the unknowns about Taiwan, but also as far as the M&A environment is concerned. Semiconductor names still do a lot of business overseas and need to get approval in areas like China, which we'd still be hard pressed to see. Whereas kind of in the software spectrum, you're in a much better position out there. M&A probably is more kind of fluid, and we think regulatory approval would kind of be met, more willingly under this new administration. So I think there are different ways to kind of play the tech space under this new administration.
You don't see regulatory risk and the possibility that some companies like, let's say, Alphabet would be confronted with the possibility of having to maybe divest of certain assets? I'm thinking of the story that we had the other day about maybe Google being forced to sell off the Chrome browser.
So possibilities, absolutely. But, that said, in the same respect, I think there's also a possibility for a company like Alphabet to be able to kind of go back into the deal-making spectrum under an administration, a Trump administration. So think about rumors earlier this year of them potentially looking at a company like a HubSpot, or even on the cybersecurity side of things with a company like Wiz. I think all of that stuff now become possibilities for a company like Alphabet, which is actually flushed with a ton of cash and, potentially could further diversify, let's say, their business away from search.
Angelo, I'm curious as to whether or not when you are having conversations with your clients that there is one issue that they are expressing a little bit of concern over.
I think as far as, where clients are at right now, I mean, I would say kind of the top of the list right now for our clients, we get asked a lot about from a concern perspective is on the valuation side of things. We've had a hell of a run when it comes to the markets here over the last 2 years, especially on the tech side of things. When you start looking at some of the multiple expansion we've seen, I think there is definitely fear out there from some investors that, maybe some of those gains that have been pulled in quite a bit kind of going into 2025. And typically, as you kind of go into year three of a bull market, if you kind of view the October 2022 lows as kind of the lows, then the year three kind of period typically tends to be one where you see slower, lower gains relative to those first 2 years, and especially kind of in a environment where policy will kind of be take kind of center stage here. There's definitely more risk out there than what we've seen, we think, over the last kind of 12 to 18 months.
Angelo, we'll leave it there. Thanks for making time to chat with us. Angelo Zino is the Vice President of Equity Research at CFRA, joining us here from New York City on the Daybreak Asia podcast. Welcome back to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. As we continue to unpack the results from Nvidia, we also want to take a broader look at what's happening in the Asia Pacific. And joining us for that is Stefanie Holtze-Jen. She is the CIO for the APAC at Deutsche Bank Private Bank, joining from our studios in Singapore. I know you're not allowed to talk about specific stocks, but I have to ask you about the Nvidia story. When you listen to the narrative that the markets received from the company, what conclusion do you come to?
The conclusion has to be that right now we're in a setup in regards to companies related to artificial intelligence theme, that there's very lofty expectations out there. It's also coming at a time where we had quite a good market rally, where lots of investors are kind of asking the right question, is that here to stay? And of course, you know, these type of results are getting scrutinized under the magnifying glass. And if there's any reason to look for short-term correction, then this is being taken as such. However, it does not derail, I think, the long-term, medium-term investment theme that we've been going with on the back of the technological advance you see with the help of companies like Nvidia. So, these are opportunities to get in at better levels, but it doesn't derail the investment thesis.
So when you imagine the applications of artificial intelligence, is there an industry that you would think really could benefit most under these circumstances?
Well, we look at everything upstream, downstream around the technology and the broader IT sector, and we have these as our sector picks for a long time already.
Let's talk a little bit about the leadership change that we've been dealing with in Washington. I think for a lot of people it means a new global paradigm where trade is concerned. President-elect Trump has said that he loves tariffs. He also loves to make deals, too. And let's talk a little bit about the dynamic that's playing out between Washington and Beijing, or will after the inauguration in January. Do you think that the U.S. and China can reach some sort of grand bargain when it comes to trade and avoid the application of a lot of these tariffs?
Well, I think there's a lot of speculation around, and I will not join the bandwagon of those because we're not yet there. We can only look at what the history is giving us to try to imply in the future. I think more importantly is what is it that the market is really concerned with at the moment. And there's next to trade and tariffs, which could have an inflationary outcome. There's also the understanding that there will be no austerity, that there's a fiscal imbalance in what's been proposed and how it will be financed. Tariffs can only make up for some part of the spend that's been proposed. So you've seen the market has been repricing to that narrative, looking at potentially less of a Fed or central bank reaction function to that new environment, being, looking at less cuts as we do as well. We see 3 cuts from the Fed coming towards us until the end of next year only. So I think that is the biggest topic right now, and that is also informing how you structure portfolios.
I'm very curious about the way that you're viewing China right now in light of a lot of stimulus that we have seen unleashed on the part of authorities in Beijing. Does that leave you to be optimistic that there is some sort of recovery happening in China right now, or maybe what has been proposed will fail to stimulate in the way in which markets have been promised?
Yeah, I'm in the camp that I believe that the probability for this stimulus to succeed has definitely picked up and risen quite remarkably. And let me just quickly go back and put this in context, because when we talk stimulus, lots of people only remember the fiscal stimulus 1.5 weeks ago. I would want to put it in context of the 3 different arrows. Let's lose the analogy of Abenomics, the 3 arrows of Cenomics that have been launched. We started out with structural reform package during the 3rd plenum in July. It was followed up in September with the monetary policy stimulus package, which came at the heels of the big Fed cut that we saw. So I would put the picture out. That was when the wind was blowing in China's sales. So that was a very timely measure. It was also very large, and it had very important components like stock stabilization program. Now the third arrow to this is the fiscal stimulus, which everybody has been waiting for, which has been finally launched in its first step, focusing really on the local government, recapitalization, exactly. So right now, if you look at it in its entirety and the way it's been delivered timely, and the two elements we hadn't in the past, which is forward guidance that there can be more if there's need be, and also I think there's quite a good communication with the market at this moment in time. So there's definitely listening to what the market is expecting and trying not to under-deliver. Again, that leads me to conclude that the probabilities have gone up, that China's been able to create its own kind of revival story without having to necessarily react to, the concerns that you mentioned earlier that come their way, and that are, of course, concerns around tariffs.
So you talk about three arrows, very similar to Abenomics. Obviously, Japan had to fight deflation for 3 decades. China seems to be struggling with that still, even though we've seen evidence that retail sales are picking up, industrial production is picking up. We just talked about how local governments may be able to respond to the property market. But is China still confronted with a major deflationary problem that may be persistent for a while?
At this moment, it still is. So I just came back from Shanghai as well, confirming this. So I do not want to paint a different picture, but I think it's also a little early to use activity data from today or that are backward looking, that are being released in the market as we speak, to kind of draw a conclusion on whether these 3 arrows have been successful or not. So you look at a realistic pathway to find out, the jury is out, obviously, whether all of this works. I think we have to look into next year. Most probably the first and the second quarter will be there to stabilize the market. And then the third quarter will also see a pickup in activity data that most probably will help to convince the last naysayer to join the bandwagon and also start broadening out investments into China again.
So how does everything that you're describing kind of inform an investment strategy? What does it translate into?
It translates into not a negative view on China. So we are out there highlighting the medium and long-term opportunity still. You have heard me saying that before. We have now seen that China is able to make year-to-date results that are resembling others in the region. So as we're building a base, these are opportunities to build out. Well, it's not just China. We also like Japan's middle and long-term story. Then, of course, this will be a sideways market that also likewise gives opportunities to invest. But having said that, we still prefer the U.S. And equities as to express our views that are fairly constructive.
Are there themes that you like right now? I'm sorry to interrupt, but I'm curious about the themes that you may be pursuing. And I know that when we were talking earlier about artificial intelligence, there is a certain herd mentality when it comes to technology. Maybe you can tell me some of the contrary positions that you're taking, kind of avoiding, what the mainstream is trying to accomplish.
Well, but you look at the playbook that we had going into the elections. There's, according to the different agendas, some of the sectors were definitely experiencing tailwinds. And of course, we have been also riding these. You look at the energy sector, you look at financials that will be benefiting from a more of a deregulatory angle. So it's not necessarily necessary to go against the market when these themes are playing out right now. You're looking at long-term investment themes as well that look also like short-term investment themes, like the artificial intelligence thing. You can also be joined, join in some of these themes that then become longer. I think there's health tech that is interesting. There's agri-tech that is interesting that we keep on highlighting, industrials. But the main drivers right now, as we've seen, and most probably will continue to see, is riding on the current themes of deregulation, benefiting financials, etc.
We were talking at the beginning of the conversation about the inflationary impact of a tariff policy. Do you believe there's opportunity still in fixed income right now? I hear a lot of what you're describing more on the equity side, but I'm wondering whether or not you want to be maybe balanced in a way that would allow you to place a bet in the fixed income markets.
Absolutely, and a balanced portfolio is also shown to be working better again in signs of stress. So fixed income is a very important part to our portfolios. And as I said, we have never been in the camp of looking for too many cuts from the Fed. I never joined the bandwagon when the market was going gung-ho on nine cuts. So we didn't have to completely change our views with the new administration coming in. So this higher for longer relative attractiveness of U.S. assets, it's been with us before. So you look at it from a bond perspective, it still argues to have large fixed income allocations. We still prefer investment grade to express that view, just to be on the higher quality side of the spectrum. And most probably we'll also see a lot of this in the short term, given that we will see the Fed not being able to react as swiftly and as pronounced as most probably the market had been pricing in before.
We'll leave it there. Stefanie, thank you so much for joining us. Stefanie Holtze-Jen, she is the CIO for the APAC at Deutsche Bank Private Bank, joining from our studios in Singapore. Thanks for listening to today's episode of Bloomberg Daybreak Asia Edition. Each weekday, we look at stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, and the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.